So let's get started officially. Welcome everybody, and thank you for joining my Property Circles for tonight's webinar. And a big shout out also to those who are tuning in Facebook. We are live. We have a guest. It's very exciting to be talking tonight to a tax expert and accountant who I will introduce shortly. Just remember that our webinars are information only. You are to do your own due diligence. Please seek out a professional's advice when it comes to investing. Go to the licensed professional in that space. Don't take advice off your brother-in-law, your mechanic, your neighbor at a barbecue, or somebody you just happen to be having a chat with in a lift. Definitely always seek out advice from people who've been there, done that, got the license and got the success stories underneath their belts as well. So with no further ado, well, let's get this party started. I'm Vidillo. For those of you who don't know me, I am the owner of Advocate Property Services. We are a national buyers agency and we are property experts. I also run a company called Property Women, which is focused on helping women educated in the space of property as well. I'm also a very proud board member of my Property Circles and a massive advocate for this sort of structure and what that could mean for people who are in the investing space. Together with me hosting tonight is the wonderful Claire Taylor. Hello, Claire Taylor.
Hi, Jo. Great to be back again on another Thursday night with you. Thank you for having me.
Awesome, awesome. Claire, you are the general manager and all things go-to when it comes to a property circle. So if you, at the end of this webinar, want to speak to somebody further, Claire's probably going to be your point of contact and should be happy to answer anyone's questions as well. Which brings me to our special guest. This is Dorin. This is Dorin Bentley. She is the owner of Bentley & Co. Accounting Services, been an accountant for about 16 years. She helps us set up the structure in the company, and please jump in if I'm saying my words wrong, Dorin, because this is your realm. But she gets the structure right for us. She's there to help and support, and if people want to use her services as well for accounting, they're absolutely able to do so. But you'll get to know a little bit more about her expertise and how she can assist. And Dorin, you and I found out we shared something in common tonight. She's the mother of 3 boys, as am I. And she did say that her sons might be coming in from soccer training at some point. So if you hear a tsunami of noise in the background, we're keeping it real, guys. That's just what life's all about anyway.
I'm hiding away, so hopefully I won't be disturbed.
Oh, look, thank you so much for doing this. I do know what it's like. So please, welcome for tonight anyway.
Thank you.
So if anyone's got questions, just remember you can jump into the chat and the Q&A. We do have some of those key questions that people do ask regularly. We are going to be addressing those. So if one of your questions pops in, you know, it may be saved towards the end as well. So just know that I am seeing them, but we'll just save it potentially towards the back end of the presentation for tonight. So this is all about my Property Circles. It's for people who want to invest in property. Perhaps they don't have enough deposit. Perhaps they do have enough deposit, but they want to have, you know, 20% share of 5 different houses. You know, it's all about being able to grow your wealth. And perhaps it is about buying properties with a group of friends that you want to have a joint venture structure done for you as well. So, and also having somebody do all the hard work. And it does take a bit of time, doesn't it, Claire, when you think you've got to liaise and find the accountant, the solicitor, the buyer's agent, et cetera, et cetera.
Yeah, that's right. It's not a simple process, but our aim is to be the duck sort of paddling madly behind the scenes and helping you coordinate all the experts so that you can start your own property circle.
Yeah, absolutely. And these experts have all come to us, tried, tested. You know, they're people who are really passionate about helping other people. I think that's really, really important that they're active investors themselves. And we'll share a little bit more about, you know, some of the other partners that we've worked with a little bit later as well. So tonight, though, we are talking accounting, you know, and also what Property Circles does, how it works. We're going to have that question time as well and talk about what your next steps might be. So I think just for those of you who aren't familiar with what a property circle is, Claire, I'm going to hand over to you. If you could just run through and sort of explain a little bit about the business and how it works.
Thanks, Jo. So I'll go through this quickly, and everyone's keen to get on to talk to Dorin. But basically, my property circles, the concept is that we help you come together with either friends and family or like-minded people to invest in property together. Investing in property is a big deal, and it can be overwhelming, and it's very expensive. If you wanted to invest in a property, you might have to save $120,000 plus all of the on-costs and the stamp duty. For most people, that's a once-in-a-lifetime purchase if they're able to do that. But it's putting all of your eggs in one basket as well, investing in one investment property and hoping that you pick the right market and hoping that it goes well. So what we do is we will help match you to find other like-minded people who you can invest with together in a group. Once you've found those people and you've decided what it is that you want to achieve, for example, you might want to buy properties in Newcastle, or you might want to buy properties to renovate, or whatever it is that your goal is to do as a group, we'll help you to coordinate all of the experts. So we have on our team accountants, bookkeepers, lawyers, conveyancers, buyers agents like Joe, basically the whole suite of experts that we can support you with on your journey to buying property together. You, with your partners or your members in your circle, you split the deposit and you share the costs, making it a much more affordable prospect to buy a property. And the average property circle is investing around $20,000 to $30,000 in their first year to get them started. A lot of those setup costs are one-off. You don't need to set up the circle twice. You don't need to engage us twice. You don't need to do a lot of the legal things twice. And so in the second, third and fourth year, if your circle does decide to buy subsequent properties together, it can be cheaper every year to do that. So the first year is the most expensive, generally, we find. And then also in year 3 or 4, you might actually be able to use the equity of your first few properties to buy additional properties together. But each circle is going to be unique. We find that the typical circle is planning to buy up to 4 properties in a 5-year period and then reevaluate where they'd like to go after that. So that's basically how it works in a nutshell, Joe. If you could just jump to the next one for me.
Yeah.
Thank you. So what we've got on this screen is pretty much the story of the first property circle. So it was started by our founder, who had an idea that she wanted to buy property with others. She wanted to start buying in the moment. She didn't want to wait until she had $150,000 saved to buy a property. And so she pulled together with her friends. They all contributed funds and they were able to buy their first property together. So from that learning, that she's the one who's come up with this concept of putting all of the accountants, all of the bookkeepers and everybody around the circle, and they've managed to buy 5 properties together, that group. Now you can see from the numbers on the screen, we've got a little scenario here where we've got Kelly, Felicity, Steve and Holly, and they've decided to jump into a property circle together. Now, if they all put in equal money, if they all put in $30,000 each, then they would all own a quarter of that circle. They would all own 25% share of that circle. But in this scenario, someone might want to contribute more money than others. Someone might only be able to contribute a little bit less. And that's easy. And if that happens every year, if there's a year where you can't contribute but other members can, all that happens is the percentage share of the entire circle adjusts. So if you've put in a bit more money than others, then you earn a greater share. So it remains fair, even if some people are putting in more money than others. And it's also, there's absolutely no legal obligation. Once you've joined with the circle, you don't have to continue to put in the same amount of money as them every year. And we have Holly listed at the bottom here. So Holly only had $5,000 available. She'd been through a really nasty personal situation where she was left without a lot of money after a divorce. And unfortunately for Holly, she just didn't have a lot of spare cash, but she really wanted to get into this property circle. And so we've come up with the Bricks for Chicks program. Bricks for Chicks is a fund where essentially we can provide match funding up to the value of $10,000 to help women, only women at this stage, buy a share into a property circle. And those funds do not have to be repaid until the properties are paid. It's on an extremely low interest rate. And it's just a way that we are trying to help more women to get into property and, build that secure financial future for themselves. So if that's a position that you find yourself in, where you're thinking, I don't even think I can get sort of that $10,000 to $20,000 together to get a share in a property circle, please email us and reach out to us about our Bricks for Chicks program as well.
That's awesome. Thank you. Yeah, look, and I love, I'll just go back a screen here. I love the fact that, yes, you can go equal shares, which is fantastic. It's not always like that in life. So, this is an opportunity to set up a structure whereby it could be parents that are contributing 50% and helping out, their children, and the children are, contributing like 50-50 themselves. So it's a lot of different ways that you can do this and cut up the pie, so to speak. So it's a really great opportunity. So let's meet an expert. We're going to be doing a series of these webinars where we're talking to our key contributors and business partners in this space as well. And so tonight, Dorin, this is you. You're in the hot seat now. So we're going to hit up with some questions, and a few emails have popped through that Claire's already highlighted some of those questions that people are saying, I want to ask this, I want to ask that. And these are the key questions that I guess you would also want to know when you're embarking in property as well. So let's get started. Can I invest using an SMSF and live in the house? And how do I make sure I'm complying with the rules around SMSF investing? Dorin, you must get questions like this one a bit.
I do. I get a lot of questions about self-managed super funds and about what people can use their super for. Superannuation legislation is very, very complicated, and it also changes all the time. I mean, even just now with COVID and the early release, you need to really speak to an expert before you make any kind of decisions with your super, and just to make sure that whatever you're doing is compliant if you've got a self-managed super fund. Because if you do something, I've had a lot of clients, every year I find somebody who's misused the money, not on purpose, but they've done something that they shouldn't have done. And then it is a bit of a marathon to get their super fund compliant. So if you are going to use your SMSF to invest in a circle, definitely speak to your accountant before you make any decision, to make sure that you can make that investment. But generally, you can use your super fund to invest in the circles. There's no compliance issues. Look through it very carefully. There's no issue of the sole purpose test, sole purpose rule, or the in-house asset. So it's that element is fine. But you definitely can't live in the property if you're investing in the circle. So the reason for that is because, generally speaking, you can't live in a property that the super fund owns, even if it's owned through a unit trust. The sole purpose of the super fund is to provide for your retirement, and if you're not retired yet, then you can't live in the property. And for this type of investment, it's probably not appropriate to retire and then live in a property that's owned by a unit trust. So I would generally say no. These investments that the circles make should just really be at arm's length, properties that are selected by the experts, and that would be you, Joe, and your team, and just based on whatever, I guess, the market, the best sort of property that the market could find, that could be found in the market, but definitely not a property that you want to live in. So yeah. As far as complying, as I said, just speak to your accountant to make sure that you're invested in an asset that is with, following the investment strategy of your fund. And if it's not, aligned with your investment strategy, then maybe it's time for a review. That has to be done anyway every year. So, yeah.
Yeah, sure. Look, I know it's a case-by-case scenario, and you've got to lean upon your, your accountant to. I bought property in my SMSF, so I know how much fun that is. Just the paperwork and the auditing, and I mean, it's great. It's made me a ton of money, but at the same time, it's just there is a lot of paperwork behind the scenes. With this living in the house, the exception might be just say, 3 siblings own a pizza shop together and it's a commercial premises. You can operate that?
Yes. So you can use the property, it's a commercial property, and you've got a business, like you say, a restaurant, or I've actually got quite a lot of clients who do use property that's owned by the super fund, whether directly or through a trust. They use it for their business. It's, that's fine, but that's a very specific exemption. And I wouldn't say that you're living in it, that your business is using it. So, yeah.
Well, I'm sure there's a few mattresses at the back of a few, but that's enough. Not about so can I invest in a property circle through a family trust?
So yeah, there's no reason why you couldn't use a family trust to invest in the property circle. So the property circle essentially is a unit trust, and each unit is owned by some entity, whether that's an individual, a family trust, a discretionary trust, or even another unit trust, or a self-managed super fund. So any entity can invest in a unit trust or be a unit holder. And yeah, I don't see any reason why you couldn't use a family trust. It definitely gives you flexibility for when the circle distributes income or capital gains. So if you have a discretionary trust, a family trust is a discretionary trust, then you have sort of more options to manage the distribution of the income in a more tax effective way. But by the end of the day, from a tax perspective, it might not be as tax effective as other options. So you, again, speak to your accountant to determine the best investment vehicle to purchase, to invest in one of the units in Property Circle. But yeah, I'll go through a little bit in a minute about the different effective tax rates based on the different kind of investment structures. And that will sort of give you some more idea about, but generally the answer is yes, you can invest through a capital trust.
Well, that's good, Dorin. This is actually a question that I've been asking you personally as well, because my husband and I, we've recently started a family trust, and we're new to it, but we have a family trust because we own shares in a few different companies and have bits and pieces flying everywhere. And we've sort of combined investment properties that we own together, and we just thought that was the best way to keep some of our assets securely. And so we're currently investing in a Property Circle with his business partners through our family trust. So it's good to know that that's all hunky-dory.
Yeah, look, it's one of those things that a lot of people don't really think about when they start buying property or any kind of assets. And I think the fact that you set up a family trust shows that you're a bit of a savvy investor, because if you're buying a property for yourself, then a family trust probably isn't the right vehicle to do that. You want to get that primary place of residence exemption to own it in your own name. But if you're starting to buy investment properties, shares, like you say, units in a Property Circle, then any kind of trust structure or I guess a trust, it gives you that protection, the asset protection, as well as the flexibility, rather than buying it in your personal name and ending up paying very high amounts of tax in the end. So
I've had a lot of clients who have signed a contract first and then asked questions second. In hindsight, maybe I shouldn't have bought it in my own name, or because of this, and they just haven't done the correct due diligence around that and what that could mean for them from a tax perspective, and lots of issues after the fact. But this is something you really need to address prior to signing the contract. How much tax will I have to pay when the properties are sold, and how will I account for my circle ownership as part of my own individual tax return?
Okay, so the first question is really the answer to the first question is based entirely on what kind of structure you're using to invest in the circle. So if you go, I think, to the next slide, maybe that will show you the effective tax rate. Yeah, that's the one. So in this scenario, in this slide, you can see it's talking about capital gains, but whether it's capital gains or an income distribution, it's taxed in the same way. Well, it's sort of taxed in the same way. I'll go into that in a little bit more detail. But basically, as you can see in this diagram, there's an individual investor, a company investor, an SMSF, and a trust. When I say trust, I'm generally talking about a discretionary trust, but you could also use a unit trust to invest in another unit trust if you wanted to. And so with a trust, the Property Circle is a trust. It's a trust structure. And the trust itself doesn't pay any tax because the trust is not a legal entity. So the beneficiaries or the unit holders in the trust are the ones that actually earn the income and pay the tax on that income. So therefore, whatever entity you use or whatever structure you use to invest in that unit trust will determine what kind of tax rate that you pay. So if you're a company investing in Property Circles and you receive an income distribution, you'll pay a company tax rate. So it'll be probably 30% unless it's a trading entity and a base rate entity, then it'll be 27.5%. But let's just say 30% just to make things easy. And if you're a self-managed super fund pays a flat rate of 15% tax. If you're an individual, then it's based on your marginal tax rate. And then if you're a trust, then it depends on who the beneficiaries in the trust are. So the unit, so the circle distributes income to your family trust, and then the family trustee distributes that income based on whatever's the best, most tax effective distribution in that financial year. So having said that, I guess the tax rate, if you're just looking at income distribution, it would be 15% tax for super fund. 47% tax is the highest marginal tax for an individual. But if you're on a lower tax bracket, like you're on only 34.5% tax, and that's how much tax you would pay. And then company 30%, and as I said, with the discretionary trust. Now, the reason that I said before that buying through, investing through the family trust gives you more flexibility for tax management is that if you've got a family trust and in that trust you've got a teenage daughter in school and a son at university, and you've got a parent who's retired and can still earn or not earning, or semi-retired, not earning a lot of money, and then you've got your non-working spouse, and then you've got yourself, you can use the distribution from the circle to figure out how to utilize those lower tax brackets first before you distribute the rest to the highest income earner. So that's the reason why family trust is kind of more flexible to invest in the property circle. But having said that, the super fund probably still will pay the lowest marginal tax at the end of the day, especially when you're looking at capital gains. So if the property circle ends at the end of the life of the circle, the properties are sold, everybody makes millions of dollars, all of that money is distributed to the unit holders. If the unit holder is a super fund, then firstly, they pay 15% tax generally on earnings, but they get a capital gains tax discount of 33%. And the effective tax rate after the discount is 10%. So on a gain of, $100,000, you're only paying 10% tax, or let's say it's $1 million because you've done so well. So it's a really effective way of earning income. And also, this probably isn't going to be relevant for a circle that's only lasting for 5 years, but if the members in the circle want to continue on for many, many years, they're happy to just keep going and they don't want to sell the property, that's the decision that they want to make. And then eventually one of the unit holders who's invested through a super fund goes into retirement and their super fund goes into pension phase, then when they get that capital gain distribution, they pay no tax at all. So it's kind of, from a long-term planning perspective, it's actually a really good way to save tax. I don't know if that's the best vehicle for you, speak to a financial advisor, but it's a good way. It's very tax effective. And as well with the discretionary trust. Now, I generally advise clients against buying property in the company because while the 30% tax rate is lower than the highest marginal rate, you don't get a tax capital gains discount. So, I generally wouldn't use a company to invest, but that's not to say that it's not one of the options, and some people might find value in that. And with the individual as well, you do get the discount, the 50% discount, and a generally low effective tax rate. But if you buy a unit in your personal name in the property circle, you're not going to have that flexibility later to decide how best to distribute the income. So yeah, that's how it works with the income distribution, whether it's income or capital gains.
Yeah. At what age with your self-managed super fund is it that you can sell property and not
so
pay
it's
tax?
Basically, well, with the self-managed super fund, you have to be 65 years old to go into pension phase to start a pension income stream from your super fund, unless you're fully retired. So if you've reached preservation age and you're fully retired, then you can go start getting an income stream or have your super convert into pension, or if you reach 65 years of age. And then all the income in your super fund is tax-free, and the income that you take from any income stream is tax-free, and any capital gains that you make, you don't pay any tax. But the only problem with that, not that there's a problem, but you can't make any more contributions to your super fund once you're over, I think, 70. So just be aware that if you do invest in a property circle, and maybe Claire knows more about this than me with regards to how property circles work, but I think you do need to continue sometimes to put more money into the property circle. So if the super fund doesn't have enough cash for that, I don't know, it really depends on your situation at the time and what what phase your super fund is in, whether you can put more money into the super fund and then use that to invest in the property circle. So yeah, again, speak to your accountant. It's very dependent on your circumstances.
Sure. Yeah, and come to us with any questions, and we can refer you through to Dorin, or speak to your own accountant, and then come back and forth to us, and we can ask, on your behalf.
So I'm not sure if that was the next. I can't remember what's
was there another question about annual that we didn't? If you go back 2 slides, Joe, I think.
Oh, sorry. How will I account for it? Okay.
Oh, wow, I'm glad you paid attention then.
I got so caught up in the tax. Sorry. Thanks, Claire. So with the tax plan, now again, it depends on what kind of investment vehicle you're using for the circle. If you've got bought units in your personal name, then you will have to declare any income. Well, in any case, whatever income you earn will have to be declared in that entity's tax return. So the accountant of the circle, that might be me. I already am doing the accounting for at least one circle at this stage. So what I generally do with that circle is I prepare the end of year reports. I prepare the income distribution statements if there's any income distribution to the members, to the unit holders, and then they take that income distribution statement to their accountant and it gets declared in their tax return. So whether that's a super fund tax return or whether that's a trust or whether it's individual or a company. So yeah, it's pretty straightforward. The accountant of the circle will advise the unit holders how much the income is that's being distributed per unit holder, and that distribution will be based on the percentage of ownership of each unit holder.
Yeah.
I should also mention that if you borrow money to invest in the units in the property circle, you can claim the interest on that borrowing against the circle income. So there's potential for negative gearing if you've invested as an individual, not so much as a super fund because super funds can't borrow money, but if you borrow as a company as well, though again, if you've got any questions about this specific thing, send me an email and I'll give you some more details about it. But yeah, so there is some potential for negative gearing as well.
Okay. Yeah, thank you for that. It's funny, I know we talk about tax minimization and all the rest, but we really appreciate what tax does by us as a society. But it's about playing the game in a smart manner, in a way. And ultimately, we want to pay tax because we've made, a profit. I mean, that's ultimately the end game. I mean, but it's important to make sure the structure's right. You've got the right advice around you as well. So thank you for that, Dorin. Now, there's
also this, did you want me to go through this exit plan? So I think
let's do that.
I think this is something that's come up as well. Some of the circle members and others have asked what happens when it's all kind of dismantled. So basically the properties, once they get sold, and they would be sold at market rate, so it would be sold on the market for the most that you could possibly get. The accountant of the circle, let's say that's me or whoever, will work out what the capital gain is. So we take the cost base of all of the properties and work out the capital gain. Then the capital gain is distributed between the different unit holders, and that's, again, it's based on their percentage of ownership. There's usually the cash distribution will not necessarily be the same as the capital gain. It just depends on how the capital gain is worked out. Again, I'm happy to give more details about that via email. And then once all of the income and capital gains have been calculated and reported in the tax return of the circle, then the statement is issued. The accountants of the unit holders receive the distribution information, and then that is just put into their respective tax returns. And that's it. And then once all of the assets have been taken out of the circle and there's no more liabilities in the circle, and all of the distributions have been made, all of the unit holders, the circle can be wound out, shut, like I guess it's closed, ceased to exist. So it's pretty simple. All of the hard work is done by the accountants and the legal experts, and the unit holders just can sit around waiting for their money, I guess.
That's, you should have led with that. I like that. Just sit around waiting for your money and we'll sort it out for you.
That should be your catchphrase, I think. That's your...
Yeah.
Claire or Dorin,
to
answer this question, I know it's one that has come up a couple of times, is just say there's 5 friends and one of them wants out, you know, they want to sort of, you know, sell up. This is when you will step in and say, well, this is their shareholding and this is how we're going to as an exit strategy for that individual, because they may not want to sell the property. Like if it's chugging along nicely and the mortgage is getting paid down and you've got great tenants in a capital growth area, which is ultimately what we're trying to achieve here. But for whatever reason, people want to free up their own assets or finances. In that instance, can you just, well, whoever wants to answer that question, what is the next steps for people who are watching now? How would you do that? How would you exit that individual out?
I can start to, and then just correct me if I'm wrong here, especially on the tax part. But essentially, you can sell your units if you're an individual who you want to get out. One of the benefits of the way a property circle is set up in a unit trust structure is that you can sell the units. There's no need to force sell properties or wait till something's sold to pay somebody out. The other members could choose to buy the units if they think this investment's going really well and I want to own a greater share of this circle. They could choose to buy those units. And the value of them, of course, will be based on the value of the properties at the time. Or someone else, we could bring in an additional person who could invest in your circle who wants to purchase your units, and then you can exit the circle. Is there anything else that people would need to take consideration of?
There might be capital gains for the unit holder. Mm-hmm. So if you, because there has to be a valuation done to determine the property circle value as a whole. And then, you know, if you invested $50,000 and after a couple of years, your $50,000 is worth $100,000, hopefully, but you want to exit, and you know they're not going to. The circle members don't want to sell the properties, then the valuation will come through, and it looks like you've made $50,000 gain. So you'll sell your units for that $100,000 and have to show the capital gain in your tax return. But you'll get a discount. You know, units are an asset like anything else, and if you've held those units for more than 12 months, then you'll get the 50% discount.
Yeah. I do remember talking to one of the circle members from the very beginning circle that was, you know, 5-6 years ago, I think it was, in terms of timing. They bought a property every year and they did so well, they were able to use the equity to then continue buying. It performed so well, people want to jump on board. So there's no lack of interest. And the fact is, if someone had to put their hand up and said, you know, for whatever reason, I'm deciding to sell up my shares, there wouldn't even become a public opportunity because they all wanted more and more of because it was working so well. It's a lovely set and forget formula for them, and they just sit back and watch the mortgage pay down and the growth go up. So I know this might look a little bit more complex, but ultimately this is the thing. Property investing isn't just always a simple vanilla transaction, and that's why a lot of people are like, oh, it might be too complicated. They use experts to help them. I think ultimately our model is there to help and support, and you know, having an expert like yourself, Dorin, to be able to calmly explain all the different steps and so if I as an individual wanted to make my own decisions, I could come to you and ask, you know, what do I do? What are my next steps? And you'd be able to sort of give that bit of a breakdown.
Yeah, absolutely.
Perfect.
Yeah, and Jo, our vision for the platform for My Property Circles is that once you're a member of the platform, you'll be able to log on and you'll be able to see circles that you could join that do have units for sale or are issuing more units in their circle. So we're not quite there yet, but we will be launching that new platform in the next couple of months. And so it'll be very transparent and easy to see. And as you said, those circles that are performing well, there's a lot of interest in them already. So if the units aren't bought by additional members who want to own a greater share, we don't think it'll be a challenge to sell a share in a property circle that's performing well.
Yeah, no, not at all. So this is a good one. And this is certainly a question. Land tax, it's good. Yeah, you just got to deal with it. But how does it work with My Property Circles? You know, as an individual, as a circle, could you sort of speak to that?
Yeah, you'd be surprised how many people don't know that land tax exists, and even more people think that it's actually a tax, because it's not a tax. It's a lovely levy that the states can just charge because they can, and so basically it's a land duty. It's kind of like paying council rates, but you're paying it to the state government, and it's based on the value of your land. So it's not based on your property value. It's based on your land value. So obviously, if you have a house, land value will be higher. If you have a studio apartment, the land value would be quite minimal. And then it also depends, of course, where you live. So not all land is created equal. And land tax is it's different in different states. So each state has its own percentage, its own rules. But essentially,
well, I don't know what just happened. But what I will say while Dorin's just off air for a moment, Claire, am I right in saying that ACT doesn't even have a threshold at all for land?
Yeah, and I think Northern Territory doesn't have land tax either. Yeah. There's funny things with territories.
Sorry about that. I'm using my phone for the camera, so it's just all of a sudden I got a phone call. Hope that doesn't happen again.
That's all right. I've never seen that happen before.
New South Wales, so each state has a different threshold. And I didn't know what all of the thresholds were, and I looked this up beforehand. Tasmania has a very low threshold, by the way, but the New South Wales threshold is $734,000. And what that means is that if you own land that's worth less than $734,000, you don't have to pay land tax. Now, if you own land that's worth more than that, like you live in your home and it's worth $1 million, the land is worth $1 million, that land is exempt because you live in it. So if it's your primary place of residence and you lived in it on the 31st of December, that's the taxing date in New South Wales. It might be different in other states, but probably essentially similar. Then you don't have to pay land tax. So the way that it works in the circle is, because it's a unit trust, each unit holder has an entitlement to a share of that land. And so because they have an entitlement, if you already own a lot of land and you've exceeded that threshold, you may have to pay some land tax on your share of the value of land in the circle. Now, I don't know, I can't tell you how much that's going to be. A lot of it depends on where the properties are invested. I know from my experience with the other circle that I look after the accounting, they have 2 properties in the Northern Territory, 2 in New South Wales and 1 in Queensland, I think. So they don't pay any land tax. Well, I don't believe that the unit holders there pay land tax, and if they do, it'll probably be very minimal. As well as that, the properties are probably most likely going to, well, again, it depends on the experts, but the properties might be apartments, for example, where the land value is very low. So yeah, I mean, it's a tax that it's an expense that you might have to pay, but it's not something that is a deal breaker for a lot of people, because it's not a huge amount, and it's really based on your own personal circumstances and what kind of entity as well you're using to invest in the trust in the first place. So if you aren't sure if you will have to pay land tax, again, I'm happy to provide more information. Send me an email. Let me know what your situation is. Maybe you're investing as a super fund or an individual, or you've got some properties. I'm happy to answer these questions, and then that could be something that could be shared, not your personal details, but shared with other circle members or other people that are interested. So yeah.
Claire, we should share on Facebook that table of land tax by state as well.
Yeah,
we can. The thresholds. So yeah, I guess it's individual. If you own, 3 properties in New South Wales, its collective land value has to be, what did you say, 734?
So in New South Wales, it's 734,000, and that's per owner. So it's not going to be, even if the circle owns $1 million worth of land, each unit holder will be assessed based on their circumstances. So yeah.
Yeah, that's awesome.
You need to own a lot of very, very expensive land in a property circle if that's your only investment property for you to be eligible to be paying that land tax.
Yeah,
definitely.
Millions of dollars worth. Yeah.
I think a lot of the people who would, well, I think generally if you're investing in the property circle, that might be kind of maybe your first investment, and so land tax is not something you really need to worry about at all.
Yeah. And this is an opportunity for you if you have got like a heavy weighting in one state, that you might want to have a circle in another state to start to, this is what people want to do. And I know quite a lot of investors who've done a lot of interstate purchases because they want to mitigate those land levies, land tax, because it does erode, the outcome of the fiscal year. So I think it's really important to make that a consideration if you're looking to potentially invest in property and you might already own a couple of properties in Victoria or Queensland or, wherever it is you've got your investments currently.
You're sounding a lot like a tax accountant, Jo, I have to say.
Oh, no. You got to go to the you got to go to the licensed professional.
That's
as somebody who's had to pay really large land tax bills in the past. Oh my gosh, that was an unpleasant day. I got a phone call that's like, hey, you owe us land tax. And I was like, what?
That's usually how people find out that it exists, by getting an assessment out of nowhere.
I mean, the thing is, the value of the land went up, and here it did. And I mean, that's a good thing, right? But ultimately, as did all of a sudden this number appear, and you're like, oh, okay, that's something I didn't bank on. So I know a lot about land tax because I got the phone call. And I did a presentation early last year, and someone at the end of the night came up to me, and he had bought 10 properties over a number of years, and his land tax bill in New South Wales was like $45,000. And I actually said to him at the time, I kind of just came out of my mouth before the filter worked. It's like, did you ever speak to an accountant about different entities or structures or going interstate or something? Like $45,000. And this was just one of those hardworking guys that wasn't a big income earner, but it's every year he's got to pay this money. So he's sitting on some good, potential land, but doesn't help the day to day. So, I find it's an interesting one to look at, and another consideration as an investor when you make those choices as well. So if anyone's got any questions, by all means, please just remember to jump into the chat and Q&A as well, because I do know this is a bit of a complex one when we're talking about unit trusts as well, but and tax, and also, of course, property investing generally. So the idea, actually, Claire, I'll get you to discuss whether to join a circle or start your own.
Yeah, so I can also see, Jo, in the attendees list tonight that we've got several people who are members of property circles who don't normally join our webinars because they're already in, but they've joined tonight. And I just wonder if you guys have any specific questions about your own property circle that you want to ask. Please feel free to just jump into that chat function and ask us as well. So yeah, please do. But basically, Jo, while we're waiting for some questions to pop in from the audience, what you can do when you register with My Property Circles is that you have an option to join a circle where you can see, and again, we'll have our new platform launching soon where this will become a lot easier and a lot more user-friendly. But even just give us a call and keep an eye on our emails that go out to our database, where we talk about all of the circles that are in progress, that people are looking for like-minded individuals to invest with them. We've got a number on the go at the moment that are looking for just those, third, fourth or fifth member to complete their circle, and then they'll be on their investing journey. But the other thing that you can do when you can jump onto our website is start your own circle. So if you have family or friends in mind, you might, as you mentioned before, Jo, there's a lot of people who are interested in starting circles with their children. So mum and dad might be able to put in the lion's share of the money. They might be putting in 50% and encouraging their kids who are in their early 20s to put in the rest, that just get going on that property journey, keep the circles together as a family for a few years and then sell, and hopefully their children will have a deposit for themselves. I think that's going to be a really common option for property circles and something we get asked about a lot. Or you might be an individual and you think, look, I've always really, really wanted to invest in property. on the Central Coast. I think it's going to boom and I'm really excited about it. You could put together your concepts and how much you want to invest and the type of properties you want to invest in, and you can list that on our platform. Like, I plan to start this circle. Who wants to come with me? Who's interested in joining with me? And you can meet other people in that way. So yeah, there's a couple of different options. Either come together with your group already made or start your own and look for people who are interested in coming on the journey with you.
Yeah. It's exciting, isn't it? Even when I was preparing for tonight's webinar, there's a house I've been keeping my eye on that's just hit the market, and it's a absolute renovator special. It needs a lot of work, and I do know what the area, what you can buy it for, what it's going to cost approximately to renovate, but I know the margin there for gain is enormous. So as I was coming, I was thinking, oh, I wonder if I can just find a few people. Like, it gives you that opportunity as an investor, like, you know, coming together to do a renovation, to, you know, like to flip a property. It helps people with joint venture, those awkward conversations when you might be doing business with friends, but you need to make sure when you're discussing something with friends, you get the right legal documents and structure set up. And that can be sometimes a hard conversation with having somebody you've got a great relationship with, but you've got to protect yourself. And when I'm saying friends, we should be talking family as well. It really is something that you've got to be mindful of before you embark on it.
Yeah, and let us help you with that. You know, let us put together those lawyers and the people who need to get that structure done to make sure that, you know, even if the worst was to happen with your personal relationship with your close friend, that the money that you've contributed is safe and secure, and that this circle's not going to fall apart. Even if people are losing jobs or unexpected things happen, that this investment is safe and secure, and you're not just relying on, you know, a handshake agreement with your best mate when you don't know what's going to happen 5 or 10 years down the track. Just let us help you make this a safe and secure investment with others.
Oh, agreed. Dorin, just a quick question, actually. I've got a question for you. If you're our chosen accountant for a circle and we're doing a big renovation project like the one I've got my own up the road, would you be able to share with us as our accountant, this is what we've done, this is what we've spent, this is what the gain's going to be, and you'd be able to say to us, look, why don't you rent it out for a period of time to take advantage of that capital gains tax discount that you get after the 12 months of ownership? Is that the sort of numbers that you could share with circles if that's what they're looking to do?
Yeah, I definitely could. And I could talk to you about, you know, the advantages and the disadvantages of different options. Yeah, it's something that I could assist with for sure. And particularly if you are using some sort of online, like cloud-based bookkeeping software to keep track of all of the costs, and then once it is, if you are thinking of renting it out, then, and you know, running the income through there as well, I'd be able to sort of give you real-time information or feedback on what's happening, the profitability, and yeah, but there's actually quite a lot of it's quite complicated, not complicated, probably requires a conversation separately, and I'd love to talk to you about it. But there is implications as well with regards to GST. If you are sort of renovating and it's sort of seen as a business activity, then there's things you need to kind of decide at the beginning and then sort of towards the end. So it's a little bit complicated, but it's definitely something that I could assist with and give advice on for sure.
Yeah, for sure. And we have another question that's popped in as well. Is there a capital gains tax discount if you're investing via a trust?
So the discount is not given to the trust itself. It's given to the end user, like the beneficiary of the trust. So it's the trust is kind of like, think of it like it filters through. So the first entity that receives the income and makes the capital gain is the circle. And then if a trust is invested in that circle, then that income flows through to that trust. And then that trust distributes the income to the end beneficiary. So if the beneficiary of that family trust or whatever kind of trust you've invested into the circle with is a company, for example, then there won't be any capital gains discount. But if the trust is, if the end beneficiary is an individual or well, one of the beauties of having a discretionary trust is that you can choose. You can have some beneficiaries who are going to be individuals. Some beneficiaries might be I don't know, a charity organization, whatever you want. So it's at your discretion. That's why it's called a discretionary trust. But essentially, if the beneficiary who receives the distribution is eligible to get a capital gains discount, then yes. But then if the beneficiary is, a non-resident, like living overseas, then there's other implications. So it really depends, as I said, depends on who the beneficiaries are.
Okay.
Yeah, so I guess, Dorin, you're saying in my example we went through before, I'm investing in a property circle through my family trust. Basically, at the end of the day, I would get the same capital gain discount if I'm getting the money through my family trust after a property is sold, or if I just invested as an individual. In terms of capital gains tax, it's still the same discount.
The capital gains tax would be exactly the same, but the benefit of your structure is that you have that in asset protection, and you also have the flexibility to go, oh, well, this year my husband and I were on similar incomes, so we're going to distribute the capital gains equally between us. But perhaps in that year, your husband decided to, I don't know, do something different with his career, and he was not working. Maybe he was studying full time. So in that year, maybe if there's an income distribution or a capital gain, you'll distribute more of the gain to him in that year than to you, just to save more tax.
Yeah.
So just give you that flexibility.
Well, like last year I was on maternity leave for 9 months of the year, so it would have been perfect to have any gain come through to me, and while he was earning a higher income, paying more tax.
Yeah.
Yeah. We have one more question
Perfect.
just popped in. Just one more question on land tax. The question is land tax always calculated on the financial year?
No, it's actually not. The taxing date is the 31st of December. Don't ask me why. It makes no sense at all. Anyway, I won't go into that. But yeah, so the taxing date is 31st of December. So wherever you were living on the 31st of December is the property that you don't have to pay tax on. So that is exempt. And then whatever other properties you owned on that date, that's how they calculate your threshold, or the land tax that you have to pay on taxable land over the threshold. So yeah.
Yeah, right. I have heard this. So just say you're selling something, you sell it on the 6th of January, or it settles on the 6th of January, and you're the owner, you have to pay land tax for that entire following calendar year, don't you? The land tax?
If you...
Okay.
It's actually interesting. If you I'd need to get your question in writing just to understand your question a little bit, because I didn't really get the question properly. But just for you to know, if you do sell property, usually you have to pay the land tax before you settle. So there's an assessment done at that point by the land title office, and so whatever tax you have to pay, but it wouldn't be for the next year, because it's based on where you were living on the 31st of December. So it will be for the previous year. In fact, you might even not have to pay any land tax for those 6 days of the year, because it's after the taxing date. But anyway, and of course the land tax itself is a deductible expense. It's not really a tax, it's actually an expense. And so you would claim it as part of the capital. Well, if it is part of a sale, it will be part of the capital gain. If it's part of, you're paying it because you're going to invest in property, then it's part of the rental expenses, and it would be claimed in the income year that you paid the land tax, even though the assessment is based on, 1st of January to 31st of December. It's a bit confusing.
Right. Yeah. No, you just made me think about something I may not have claimed for a sale. Dorin's obviously getting a phone call. So we have another question for her, but until her phone stops ringing, I'll go.
Dorin. Don't you hate it when you cause the technical disruption? You think, oh no.
Oh God.
Okay, so we do have another question for you. Is there a specific number of people you need to set up a family trust? And thank you.
No, not really. A family trust. So with a family trust, generally you need to have a trustee. The trustee can be a company, or it can be an individual, or it can be two individuals. Generally it'll be one individual or a company with multiple directors, or one director, whatever. So there needs to be a trustee. And with the the beneficiaries, with a discretionary trust particularly, there can be multiple beneficiaries. I mean, usually you nominate somebody to be the primary beneficiary. So, let's say a husband and wife and maybe their kids. But depending on the trust deed, and this is more of a legal question, but I've seen a lot of these trust deeds. If the trust deed is quite broad, then usually it will say something like anyone who is related to the first beneficiaries, and then the next level of beneficiaries will be anyone that the trustee deems is eligible to receive a benefit. So it could be, like I said before, it could be a charity organization or a school. You could nominate your grandparents, you could nominate whatever. I mean, the only people I would advise against nominating would be minors, because then you have to pay very high tax rates. There's penalty rates for that. And that's just, anti-avoidance provisions. So, yeah.
So ultimately, the terminology family trust, it could still be just an individual. It's not always just your mum and dad or a bunch of...
Yeah. You need one individual to set it up. So a trust itself is not a legal entity in itself. So the legal entity is actually the trustee. And the trustee can be a company or an individual. So if I wanted to set up a family trust, it could be the Dorin Bentley Family Trust, and I'm the only trustee and I'm the only beneficiary listed in the trust deed. But I can nominate other people to be beneficiaries, and I don't have to make that determination at any, at the inception of the trust.
All right, that's all good. Thank you so much. Sorry, Claire, what's next? What's next for people who are watching who've got a piqued interest?
Well, if you are interested in knowing more about Property Circles, jump on our website, contact us at any stage. All of our contact details are on there. We'd recommend that you talk to your own financial advisors or accountants to make sure that investing in a property circle is the right decision for you. If you've got other friends or family in mind that you want to get in touch with and think, yes, we should invest in something together, talk to them and then call us. That's basically all you have to do, and we can help you get the ball rolling. We'd be happy to set up a Zoom meeting or meet with you in person if that's possible. And get everything set up and get sorted and get you on your journey, basically. It's all pretty simple. There's a lot more information on our website, but if it's easiest for you to pick up the phone, then there's a phone number on there. Please do that. There's not a phone number on there. There could be on that slide, but if you send us an email, I'll give you a call back. I think we've got another question,
You're not,
Joe.
you're not off the hook yet, Dorin.
Sorry.
If you have your name in several properties in your individual name, owned jointly with others in the same state, is land tax calculated on your share of each house?
I'm sorry. Can you repeat the question?
So if you have in your own name, so if Joe Vidillo has 5 properties in New South Wales and I own 20% share in each property, is the land tax calculated on my share of each house?
It is, yeah. It's based on your percentage of ownership. Yeah.
Yeah. So it's a parity percentage.
Today, I just submitted a land tax assessment for a client, and I had to indicate their ownership percentage. So yeah, they do look at that.
Yeah, sure. So yeah, you could be 5% of one property and 35% of another, and it just comes down to your individual circumstances, your liabilities as an individual. If it's your individual name that owns that share in the property itself. Yeah. Dorin, if anyone wants to ask you a bit more about your services or how they can reach out to you, where should how should they find you?
Well, actually, I think that there should be a link on the My Property Circles website under the partners section. So just go there and click there. Or you can just contact Claire as well, and she can put you in touch with me. So I'm more than happy to provide more information. And yeah, I'm really happy to, get people feeling confident about their decisions, whatever they may be. So it's, please get in touch.
Yeah, absolutely.
Yeah. And that email on your screen, that info@mypropertycircles.com, that will get through to me, and we can point you in the right direction, and really happy to chat and answer any questions that you've got, not just about tax, but about property circles in general. And we've got all of those experts. We can refer you through to lawyers. We can basically put you in touch with whoever you need to do. As Dorin, I think you put that really well. Make sure that you're confident in that you're investing in the right place for you. And yeah, we're happy to help you make those decisions.
Yeah, thank you so much, Dorin, and thank you. I've had a couple of people pop in and say thank you for tonight, but thank you for sharing this last hour with us. Please reach out if you've got ideas, you've got properties in mind. Claire, I'll have to give you a phone call about my renovator special myself. Dorin, you've been wonderful.
Send me an email about that, Joe. I'll give you more.
Yeah.
Thank you so much, and hopefully I'll be seeing a few of you build your own circles up as well. So thank you very much.
My pleasure.